Hi everyone, I am Sayan and welcome again to my channel. Now in my last video I had talked about how I used multiple time frames to analyze a stock. I introduced two terms, higher time frame chart, for example a monthly or weekly chart to have a bird's eye view of what the stock is doing. Secondly, using the lower time frame chart, for example a daily chart, to search for entries. Now if you want to see my last video, I suggest you click on the card on the top right corner of your video. I will also have an end screen with a link to this video. Today's video is more about understanding support and resistances. To the people who have seen the last video, identifying support and resistance is one of the things we do on the higher time frame. So today we are going to discuss three things. Point number one, what is demand and supply and how it relates to your support and resistance. Point number two, how demand and supply changes in a market. So we are going to see how a historical support can become a resistance and vice versa. And point number three, how I personally use support and resistance in my trading. I will also be showing you how you can use support and resistance to calculate how much to invest in a particular trade. So please stay with me throughout this entire video. Now point number one, what is supply and demand? Supply is a price zone where sellers are likely to triumph over the buyers, which will cause the price to go up. Essentially, it means that there are more people selling a stock than those who are buying it. It can be of many reasons, for example, a bad quarterly result. And conversely, demand is a price zone where buyers are likely to prevail over the sellers, which will cause the price to shoot up. So now there are more buyers for a particular stock than sellers. And these two can have many reasons, like a good quarterly results. So this is a basic definition anyway, but let me demonstrate. So guys, here we are once again on iCharts. So let's take an example where the price has done something like this. So if we consider the stock started at 100 rupees and the price moved up to 150 rupees. However, it failed to sustain at this level because the sellers thought this price was too high. So the sellers sold their stock, resulting in oversupply, and whenever this happens, prices will fall. So the prices moved back down to 100 rupees. However, at this price level, the buyers came in and the demand was more, which is why the prices went up again. So since the price failed to move higher than 150 rupees, this price level will be termed as a resistance, as marked by the red line. And the price level of 100 rupees also gave rise to demand. So this price level will be considered support, as marked by the green line. Now for the price level to be considered as a major support or resistance, it needs to be revalidated by the price movement. So in this case, since the price moved back and forth between the price range of 100 and 150, those would be considered a valid support and a valid resistance level. Now at the point marked by the red square, the price failed to hold this support and prices moved to a new low of 50 rupees. Now this would be considered a violation of a support level, and this is where the mentality of the sellers changed and they were not ready to pay even 100 rupees for the stock. So it fell to a new low. Now it is very natural in this market to retest the last major support level to see if the buyers are ready to buy above the last support. If the sellers overpower the buyers at this level, then it can be safely stated the previous support level of 100 rupees has now become a resistance. Now applying the same principle, we can say that in this next diagram that at the point denoted by the green square, the mentality of the buyers changed and they are now ready to buy at prices above rupees 150. Now in the same way as retesting of support, the price now moves back to rupees 150 sorry, and if the price bounces off rupees 150 levels, then it has successfully established rupees 150 as support levels. So now one would say that the previous resistance has now become a future support. So I hope you understand how support and resistance can dynamically change in a market based on the current perception of the market participants. Now let's have a look at the chart of State Bank of India and try to apply what we have learned. Now before we do this, let me just mention that we are using a Heikin-Ashi chart over here instead of a normal candlestick chart. It doesn't present any significant advantage of a candlestick chart, but I just personally prefer it as it creates an uniform looking chart. Okay, so let us see what the price has done on the weekly chart. Now for beginners who have trouble spotting the support and resistances, you could probably use the line tool, as I will show you next. I personally like to use the line tool to draw over the price movement, as it helps me to spot the price action better. However, you may or may not choose to do it. Okay, so let me just show you. This is iCharts, and you are seeing the weekly chart of State Bank of India. So pick the polyline tool from over here and just draw the price action. Now to draw the line segment, you just need to spot the major price movements and just those movements which kind of sticks out in front of you, like this. Okay, this would be enough for now. So let us make this red. So now after you have done this like so, you would be able to see the price bouncing off repeatedly of a couple of levels. Now let me show you the major support and resistance zone in this chart. Now at this point, just follow my cursor, you will see at the price of 92 rupees almost, the price has bounced off almost 4 times over here, over here, over here, and the last one over here. Okay, and the major resistance levels right at my cursor, at over here and then over here. Okay, so the price zones where it falls, it is where the sellers were outweighing the buyers. Okay, so these zones are called major resistance zones, which I explained to you in the earlier chart as well. And the price zones where it gains upward momentum, like over here, demand was greater, so these are support zones. Now let's focus on a couple of points in this chart. For example, if you take point A, where it had just broken out from the resistance as marked by point F, and just after breaking this resistance, it pulled back down to point number B, which was the historic resistance level. So at point B, the stock found support, so there was demand over there, and then it started to move up again. So we see that a historical resistance can become a support zone. The same scenario repeated at point C and point D. Now point D, which coincides with resistance zone A, is now providing support. The reverse scenario, where a historic support can become a resistance, is also visible in this chart at points E and F. So the price, after pulling back a little at point E, finally broke through it, and then the relief rally ended at point F, which was earlier providing support, although it was not a major support zone. So in all of these cases, we see that in moving market, it is pretty common for resistance to become a support and vice versa. So I hope you have learned a little bit on identifying support and resistances in the earlier charts. Now identifying key price levels is one of the most important activities in technical analysis. Being aware of these levels can actually greatly enhance your forecasting abilities. So if a stock is approaching an important support level, you could be extra vigilant and look for signs of increased buying and a potential reversal of momentum. Now let's look at this chart, which is of Colgate-Palmolive, and see how we can use support and resistance to trade in this trending market, which is our last topic of discussion in this video. Now I used a new term called trend. Many of you newbie traders maybe heard of the phrase trend is your friend, but what do you mean by it? A trend can be of two types: an uptrend, which we normally call a bull market, and a downtrend, which we call a bear market. An example of a structural bull market is provided over here, where the price is making higher highs and higher lows, as you can see in this case. Conversely, a bear market should be making lower highs and lower lows. Now in this example of Colgate-Palmolive, it is a classic example of a bull market. I have already marked the higher highs and the higher lows, which defines that this is a bull market. And also, as in the previous case, you will see an example where after breaking a historic resistance, prices are pulling back to the last historic resistance and getting support over here to continue the upward momentum. So in all the cases where marked by the green arrow, you will see that the prices are moving up after pulling back to the last historic resistance. Now, the way to enter a position in a trending market, I feel, is to wait for the price to pull back to a support level and then see signs of reversal to enter into the positions. This way, your risk can be very small and you can set your first target to the last high and trail your stops for the rest of the position. You can also use support and resistance level to identify how much risk you are taking and thereby assess how much money you are going to put in that trade. And I frequently use this method in my personal trading as well. So let me explain what I am talking about in the last 2 points. So what I was saying is, to enter a position in a trending market, or for that in a bull market for example, if you want to go for a long position, you can probably wait, like after breaking the last historic resistance, let the price pull back to the resistance level and see for signs of increased buying around these areas. So from here, or maybe here and probably over here as well, you could check for your indicators and see if the momentum is favoring you again or not. So if it's favoring you, you could probably buy into that area. Now the second point which I mentioned is about the stop losses and how you can use support and resistance to minimize your risk. Let me explain how. Now let's say you have rupees 10,000 and you are willing to risk only rupees 200 on that trade. So that is about 2%. Now if your current market price is rupees 50 and let's see you identify your stop loss based on the last minor low, which is over here rupees 40. So you stand to lose So let's say you have rupees 10,000 and you are willing to risk only 200 rupees on that trade. So that is about 2%. Now if your current market price is rupees 50 and let's say you identify your stop loss based on the last structural low, which is, let's take an example, rupees 40 over here. So you stand to lose rupees 10 if you are wrong about this trade. So based on these figures, you can say that you are only allow yourself to buy rupees 200 divided by rupees 10, which comes to around 20 shares. So to figure, greater the risk, lower is the investment, and vice versa. So this is a very good way to limit your losses and save the capital. And this is a strategy which I use in my trading. So guys, I hope you have gained something from this video. I will keep on making more such videos for traders who want to invest in learning about trading. I am also planning to do some stock reviews which might help you. So if you like this video, please like, share this video, and also please subscribe if you haven't already done so.